Welcome to the Deep Dive. Today, we're digging into a really interesting one. The Q3 2025 earnings call for Himax Technologies, ticker HIMX.
Yeah, this one was held pre-market on November 6th, and it was a very mixed bag.
That's putting it mildly. The market reaction was just deeply contradictory.
And that's exactly why we need to unpack it. You had management on the call, emphasizing how they beat their own internal targets. They really did execute on the top line.
But the market's reaction was pure disappointment.
Pure disappointment. It sent the stock down almost 13%. So our mission today is to figure out why. Why did the numbers cause such a negative reaction, despite what looks like, on the surface, some pretty solid underlying strength? We have to separate the P&L shock from the strategic story they're trying to tell.
Okay, let's start right there with the headline numbers that created all this confusion.
Okay.
So, Q3 revenue, it came in at $199.2 million.
Which was a clear beat, a massive beat, actually.
Right. It was 6 or 7% above what the street was expecting, and it just blew past the company's own guidance, which, had predicted a pretty big sequential decline, maybe up to 17%.
So top line, a definite win, no question. But then we get to the bottom line, and that's where the mood just soured.
Yeah, the EPS, IFRS diluted EPS, was just $0.006 per ADS, a fraction of a cent.
Now, technically, and this is what management pointed to, technically that was a victory for them. They had guided for an actual loss of 2 to 4 cents.
So they turned a guided loss into a tiny, tiny profit.
Exactly. But that word tiny is doing all the work there, isn't it? Especially when you put it next to Q2's number, which was almost 10 cents.
So you have this huge revenue beat on one hand, and on the other, the profit is basically gone. It just evaporated from one quarter to the next. It tells you there's something serious going on underneath that revenue number.
That's the core of it. The market saw a company bringing in cash, but just completely failing to turn it into earnings. It doesn't matter how low you set the bar, that kind of result was just not what anyone was looking for.
So let's get into those details. What was the problem?
Margins. Simple as that.
Okay, so gross margin was fine, right? It held steady at 30.2%, which was right in line with their guidance.
Right, no issues there. The problem was the operating margin. That's the number that really tells you how efficient the business is running. And it absolutely collapsed.
It collapsed out.
It didn't just fall, it went negative. They posted a small operating loss of about $600,000, so a negative 0.3% margin.
And that's down from what, 8.4% in Q2?
8.4%, yeah, huge swing. And the reason was pure cost. Operating expenses, or OPEX, jumped 24% sequentially.
A 24% jump in one quarter is just massive. How did management explain that? Were they just caught by surprise?
Well, they framed it as planned, but it was a confluence of things. The biggest piece was $8.1 million in annual employee bonus accruals. That's a normal Q3 thing, but the size of it here just ate up all the profit.
Okay, so bonuses. What else?
Then you had higher tape-out costs, that's the engineering costs for new chips, and some negative currency effects. So you had these big scheduled costs hit at the exact same time as they were accelerating some other spending.
And it just wiped everything out.
It wiped out everything they made at the gross margin level, yes.
So the market is worried that this isn't a one-off, but maybe a new higher cost structure?
Yeah.
But what about the actual health of the business, the balance sheet?
And that's the other side of the coin. And it's a point that I think got lost in the panic. If you look at cash flow, free cash flow was actually positive.
Oh, really?
Yeah, only by about 0.9 million. So not a huge number, but it's a huge improvement from a year ago when they were burning through almost 6 million. So despite the P&L pain, they are generating cash. That shows some stability.
Okay, so the core business is stable. It's just the timing of these big expenses created a really ugly P&L for the quarter. And that stability, I assume, comes from their big strategic push into automotive.
Absolutely. The auto display IC business is the anchor now. It's over 50% of total revenue again. And we're not talking about simple chips here. We're talking DDICs, TDDIs, Tcons, OLED drivers.
For our listener, maybe break that down. Why are those so important?
Because they're the brains behind the modern smart cockpit. You see these huge, beautiful screens in new cars. These chips are what make them work. The DDICs and TDDIs handle the display and the touch functions. The Tcon manages all the data flowing to that screen. It's complex, high-barrier tech.
And it's growing fast.
Very fast. Management said their automotive Tcon revenue specifically is on track for about 50% year-over-year growth in 2025. That's huge.
Okay, so a powerful long-term story. But the market as always, is obsessed with tomorrow.
Yeah.
Which brings us to the Q4 guidance. And this was the real shocker.
This was the nail in the coffin for the stock on that day, yeah. They guided Q4 revenue to be flat, around $199 million. Gross margin also flat to slightly up, all fine.
But then came the EPS guide.
Then came the EPS guide, 2 to 4 cents per ADS.
And the street was expecting, what, 8 cents?
Roughly 8 cents, yeah. So they guided 50% below consensus. Investors immediately thought, okay, the Q3 OPEX spike isn't a one-time thing, it's a structural problem now.
So management had to do some serious explaining. They said it was because of two non-recurring items, right?
Exactly. They basically said, we're pushing more pain into Q4 to clean things up. So factor one was an income tax adjustment. They pretty much admitted they under-accrued taxes in Q3, so they have to make up for it in Q4.
Okay, an accounting thing. And factor two?
Factor two was more strategic, but just as painful for the bottom line. R&D. They're deliberately spiking R&D spending.
What?
Well, they have some expensive new tape-outs for future products, and crucially, they're accelerating spending tied to a government R&D grant for their WiseEye product line. So the market sees this as them just ripping the Band-Aid off, taking the earnings hit now.
The price of innovation, as they'd say.
That's the narrative. All this immediate pain is to pay for the future, for the 3 pillars of growth that they kept talking about on the call.
Right, let's get into those, because this is the whole bull case for the stock. WiseEye, CPO, and AR smart glasses.
These are the high barrier businesses that they believe are going to drive the next wave of growth starting in 2026, 2027.
So let's start with pillar one, WiseEye. What is it and where are we seeing it?
WiseEye is their ultra-low-power AI tech. Think always on, but without killing the battery. We're seeing it pop up in AI laptops for things like presence detection, in smart locks, and in next-gen smart glasses. Management really thinks this is an engine that's just starting to rev up.
Okay. Pillar two sounds even more futuristic. Co-packaged optics, or CPO. What problem is this solving?
CPO is their big bet on the AI data center. You have all these powerful AI chips, right? The bottleneck isn't the chip itself, it's moving data between the chips. The plumbing. And traditional copper wiring just can't keep up. CPO uses light optics packaged right next to the silicon to move data. It's faster, more efficient, uses less power.
So they're replacing wires with light, basically.
In a nutshell, yes. They're targeting mass production for 2026, and they were talking about explosive growth in 2028. This is a huge R&D bet, but the payoff could be enormous.
And the third pillar, AR and smart glasses, which feels like it's in their DNA.
It is. This plays to their strengths in displays. They're highlighting a new front-lit LCoS microdisplay. LCoS, liquid crystal on silicon, gives you amazing resolution in a tiny package, which is exactly what you need for glasses.
And they threw out a pretty wild spec for brightness. 350,000 nits? I mean, my TV is maybe 1,000 nits. That sounds blindingly bright.
It sounds insane, but it's what you need. For an AR image to look solid when you're outside on a sunny day, you need incredible brightness to compete with the sun.
Ah, okay. That makes sense. It's about overcoming ambient light.
Exactly. And they said this new display is already sampling at major global tech companies, which tells you the big players are taking it very seriously.
So you have this incredible long-term story, WiseEye, CPO, AR, and yet the stock got crushed, down almost 13%. Let's go back to that central conflict. Why?
It's a clash of time horizons. It's that simple. Management is talking about 2027. They're focused on CPO, on WiseEye. The market is focused on the next 2 quarters.
And the next 2 quarters look painful.
Very painful. The negative operating margin, the huge OPEX jump, that terrible Q4 guide. It tells investors that this earnings reset is going to be slow and expensive. And Wall Street just isn't willing to pay for a 2027 story when the 2025 story looks so messy.
Did they say anything about their core auto market that might have spooked people too?
They did. While their own shipments are strong, they gave a reality check. They said they have limited short-term visibility and are only expecting a mild recovery in the broader auto market in 2026.
So not the explosive rebound people were hoping for.
No, more of an inventory restock. And that just added to the negative sentiment, and you see it when you compare Himax to its peers. The stock was already down over 20% in the month before earnings, way worse than the overall semiconductor ETF.
So investors are punishing them specifically for these internal cost issues, and they're completely discounting the long-term AI story.
Which creates a fascinating dislocation, a perfect setup for our next segment.
Right. It's time for the segment where we pitch an outrageous but plausible trade idea directly to you, the investment committee. This is not financial advice.
Okay, let's call this one the double-dated futures play. The thesis is very straightforward. The market is having a hysterical overreaction to the Q4 margin cleanup. It's focused entirely on the near-term pain and is completely missing the value of the long-term catalysts like CPO and that 2027 auto OLED ramp.
Okay, so how do you trade that timing mismatch?
You build a time-based spread. First, you have to protect yourself from the near-term volatility. So you buy out-of-the-money puts with an expiration tied to the Q4 earnings report. So probably an expiration in early Q1 2026.
So cheap insurance against any more bad news in the short term.
Exactly. Then at the same time, you buy long-dated calls leaps with an expiration out in early 2027. You're placing a bet that by then, the CPO story will be real, the auto OLED ramp will be accelerating, and the market will have woken up to the value.
So you're shorting the current uncertainty and going along the future technology roadmap.
That's the play. You're exploiting the gap between the messy P&L today and the high-value tech of tomorrow.
What's the biggest risk there? What could make that trade go wrong?
The risk is all about timing. If CPO adoption slips, if the AR customers take longer to validate the tech, if that 2027 revenue story starts looking more like a 2028 or 2029 story, then those long-dated calls you bought just lose their value over time. You're betting on their execution timeline being real.
A really fascinating way to look at it. So to sum it all up, Himax is in the middle of a major strategic pivot to high-value markets like auto, AI, and optics. But the cost of that pivot is hitting the P&L hard right now with OPEX spikes and that really low Q4 guide creating a tough earnings reset.
And that leads to the final provocative thought for you to chew on. We know their core automotive display business has a commanding 50% plus market share. It is an incredibly defensible position in the smart cockpit revolution. So, is the massive discount the market is applying to this stock a rational reaction to some temporary cost issues? Or is it a complete overreaction that ignores just how entrenched and valuable their position is in the future of the automobile?
That is the multi-billion-dollar question. And remember, this discussion was for informational purposes only, not financial advice. Thank you for joining the deep dive. We encourage you to keep a close eye on these emerging themes in AI, optics, and automotive tech. Close the deep dive.